Thanks for clicking. Bank of Canada Deputy Governor Toni Gravelle gave a speech where he went over under what conditions the Bank of Canada would continue to raise interest rates, and more importantly, under what conditions would they reverse course on interest rates. The speech was given in French, and as I don't speak French,
disappointment.
We won't have any clips. However, the Bank of Canada has released the text on its website, which can definitely contain a few surprises. We've been hearing from the Bank of Canada for the past few months that we should be expecting higher interest rates. Interest rates are on the rise. The era of cheap money is over. Yet the speech by the Deputy Governor seems to point in a different direction, as it discusses at which point the bank will be considering reversing its interest rate hike policy.
Make up your mind!
Given that the interest rate hikes have just started, and that the Bank of Canada is still well under 2018 levels, talks of reversals already is definitely concerning. So what I want to do today is go over the Deputy Governor's speech, looking at what would cause the bank to continue to raise interest rates, what will cause the bank to reverse interest rates, and then what to look for next. We're expecting a big week in Canada real estate news next week, as we're expecting to get the CREA's April real estate data, as well as our inflation rate from StatsCan next Wednesday. We'll obviously have updates out on the real estate data and the inflation data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into the speech. Deputy Governor Gravelle premised his speech by saying that the policy rate is going to be going up for the foreseeable future, as rates are currently too stimulative. And we've talked about this on this channel before, with the policy rate currently at 1% with an inflation rate of 6.7%. Current interest rates still encourage Canadians to spend, still don't do a whole lot to bring down our inflation rate. Gravelle then went on to discuss the two major reasons why the Bank of Canada would raise interest rates. The first being global supply chain issues. The Bank of Canada does not have any direct control over these supply chain issues, so it is going to target what it can target. So, should these supply chain issues persist, the bank will continue to target demand. And Tiff Macklem has talked about this before.
But raising the policy rate will not fix supply chain disruptions, nor will it lower oil prices. What monetary policy can do is make borrowing more expensive, which slows domestic demand.
Second, the Bank of Canada will be raising rates if Canadians continue their current spending habits. In normal times, the Bank of Canada can induce or discourage spending vis-a-vis the interest rate. However, Canadians have racked up $12,000 on average in savings throughout the pandemic, and as such, the Bank of Canada is concerned that higher interest rates might not discourage people from spending, might not discourage Canadians from spending that $12,000 on average that they have saved up. And as such, the Bank of Canada will raise rates in order to discourage what they can.
Don't make me do this.
And this is the really interesting part. The Deputy Governor went over why the Bank of Canada is already thinking of reversing its interest rate hikes. While Gravelle acknowledged that the bank would reverse course if prices start to reverse as well,
Captain Obvious.
He then went on to discuss housing and debt levels. Canadian debt levels are currently sitting at 186% of household income, up from the pre-pandemic rate of 181%. As a result, Gravelle said that interest rate hikes designed to slow down spending may very well slow down spending much more than anticipated, as higher debt servicing costs will weigh more on the pocketbooks of Canadians going forward. And we've talked about this in the past. Can Canadians afford 2022 prices at 2019 interest rates? So, according to Gravelle, should higher interest rates put too much pressure on the backs of Canadians due to their higher than normal debt servicing costs, the amount of debt that Canadians took on during the pandemic, due in large part to overly high house prices? Should this put an undue burden on the backs of Canadians, the Bank of Canada may consider reversing course on interest rates. And we were talking about this even before the Bank of Canada was discussing interest rate hikes, before they raised rates by 75 basis points. With Canadians' private debt to GDP ratio at its highest level in years, we're already starting to feel the pinch of these higher interest rates, and the banks only raised rates by 75 basis points. This, combined with the house price reversals that we saw in April, and I'm already seeing quite a bit of it in my market in the month of May, some are already arguing that the bank will need to reverse course sooner than they had anticipated in order to reprop up the housing market. Obviously, talk is just talk, and the bank isn't suggesting they will be reversing course on interest rates in the next couple of months. But I do think that the speed of which Canada's real estate prices reversed in April caught the Bank of Canada off guard, and now they're starting to already discuss reversing interest rate hikes sometime in the future, due in large part to elevated debt servicing costs on the part of Canadians. The bank has one primary tool to fight inflation, and that is interest rate hikes. And if our economy, if our debt levels prove unable to withstand a 1%, a 2% policy rate hike, then that is going to severely limit the Bank of Canada's ability to fight inflation in the months and years ahead. In the future, as it's not clear yet if the relatively marginal rate hikes that have already come down the pipe, that we're expecting to come down the pipe in June and July, whether or not they're going to be sufficient to tamp down our inflation rate. And if our debt levels can't handle higher interest rates, if our economy can't handle higher interest rates going into the future, then we are going to be severely limited in the extent to which we are able to combat this inflation rate. With all of that said, we should have a much better idea how high the Bank of Canada will have to raise interest rates when we get the inflation data coming out next Wednesday. We'll obviously have updates out on that on this channel, and if you want to get those updates, make sure you click like and subscribe, and thanks so much for watching.